Welcome to the Hidden Money Podcast. We are super excited to have one of our good friends and clients, Josh Alexander, join us. Josh hails from ALX Land. It's a real estate development firm, and he's a syndicator. A little bit about Josh. He, his wife, and two sons and daughter all live in Southlake, Texas. He graduated from the University of Oklahoma in 2008 with a bachelor's degree in both marketing and management. ALX, Josh leads the vision, strategy, business development, and equity management. Josh has a pretty good career already. He's a young guy, but he's been incredibly successful in real estate. And he also seems to be a fortune teller. He and I had a conversation this past summer, and I asked him, what do you think's happening with the economy? I think we just had our first interest rate hike, and he, to the T, predicted what would happen all the way up through January of 2023. And I am now going to ask him to pick all of my investments going forward, Josh. So thank you very much for being here, man.
Yeah, thanks, Mike. Happy to be here.
We're located here in Texas. And so the market in Texas is always a unique beast. We have a lot of people moving here. So depending on where our listeners in, some of this just may sound shocking, but Josh, kind of what's going on in the Texas market, and what have you been hearing if you got your ear to the ground on real estate, at least in Texas? What are you hearing out there?
Still extremely competitive. If you're looking at kind of residential versus multifamily, residential is, I think, obviously taking a little bit of a hit. People have seen that across the country with interest rates going up, mortgage rates going up. But here in Texas, we seem to be a little bit more insulated towards those rate hikes. We still have a lot of people moving in. Still read an article today in Dallas Morning News that Texas led the nation in job growth in 2022. 650,000 jobs or something. This is Dallas Morning News.
Wow.
So there's a lot of reasons to be optimistic and excited about Texas. It's very business friendly. There's just a lot of opportunity, good schools. And I think it's just from the way that COVID was handled and other things, just the way the state is run, I think people are looking for a place where they can come and still have a lot of opportunity to work and grow, and a good place to invest as far as business growth and job creation. Property-wise, we haven't seen much of a decrease in values or any slowdown in competition. We have seen less properties come to market. I think you guys know, people listen to another in multifamily, we value things based on cap rates primarily. And so where cap rates were a year ago, let's say DFW multifamily averaged a cap rate somewhere in the mid fours. Now we're seeing those cap rates kind of run down a little bit to low fives. So I don't think that has anything to do with other economic factors as far as people moving in or job availability, but just simply what it costs to own these properties right now.
So my grandfather, who grew up during the Depression, he did pretty well in real estate. And he used to always say, and I know we've all heard this a lot, but when it comes to real estate investment, location is the number one thing, one of the most important things. What areas, I know we have talked about Texas, but especially DFW maybe and Austin, but what are some of the greatest areas for potential investing if you're looking to invest in multifamily housing? Which geographies?
Yeah. And to add to that, I'd say the one thing that can cover up mistakes, cover up underwriting mistakes, cover up management mistakes, the one thing that can do that is location will typically, the values will typically continue to appreciate. The properties will in the right locations. So it's key. Now, those are obviously more expensive and there's less risk involved. So sometimes the better location, the more expensive the property, the less return that's going to be offered for that particular investment. But yeah, absolutely. Right location can cover up a lot of mistakes. But in the locations anywhere in Dallas, Fort Worth, Dallas Metro, Fort Worth Metro, Arlington, Bedford, the mid-cities area, where we've got some at Richardson. We've got a property on Amarillo. So really, I don't know of any market in Texas that hasn't grown like crazy over the last couple of years. I don't know of any market that I would say definitely avoid. You get in out west and you're heavily energy dependent, I'd be a little bit weary there because you're going to have big swings in occupancy and in what you can charge a rent. And that's obviously going to really impact the values. But if you can get where we like to kind of stay, we love DFW because it's so economically diverse. If you're going to get into any market where that's going to most closely match the overall economic picture in the country, it's DFW. We got a little bit of everything here. And I don't feel like we're too heavy leaning in any one industry. So I'd say anywhere at DFW is a good. Now, when I say that, we all know that certain pockets in any market in any city are not going to do as well as others. So you just be mindful of, yeah, DFW, okay, that checks a big box. Yes, that's good. Now it's like hone in and get a little bit more information on exactly where in the neighborhood, in the city, and what's the plan. What does it look like on a more granular level in that particular market? And how does that property in that market compare to other properties in that market? So there's certainly other considerations, not to just say, hey, DFW, yeah, let's go for it no matter what. But we like DFW. Austin is obviously a great market in Texas, but we've seen that's really been overly saturated. I think the last couple of years, it's super expensive. San Antonio and Houston are great places to invest. Any of the primary markets in Texas, I think you're in good shape as long as you're in a right property and the right situation. But there's a lot of properties in all those markets that fit that. They're in good locations. They're doing well. There's a lot to go after in all the primaries. And then we can get into secondary and tertiary stuff too. But you're going to do pretty well, I think, if you're in a good spot within one of those primary markets in Texas.
So I'd like to further kind of get your thoughts how it is that you focus and find a property, underwrite it, and feel confident enough that you're going to make money. And I've seen the way you model stuff. It's pretty conservative, but how do you go through that process and get comfortable enough before you can take it to potential people and say, hey, I want to invest your money, and this is why I think it's a good thing? Walk us through that process a little bit more, if you wouldn't mind.
Yeah. At some point, you do the best you can. You see where it's been. There's different pieces to that. You look back, you get historical financials from the previous owner. Typically, they'll give you 12 months to 2 years to just show you what the property's been doing. Then you take that and then you put it up next to what's the market like for rents? What are the comps in the area? Is there any room? Is there room for us at this property to raise rents to match those other comps? And an important part of that is to determine what is a comp. What am I going to have to do to this property to make it look like that one? To where I can actually compare it and say, yeah, somebody would be willing to pay the same price for that apartment down the street as they would for this one. So there's a lot that goes into it. It takes a lot of people with different skill sets. You need to have a property manager that looks at it and says, yeah, I think these historical expenses line up. And I think that we can operate in a similar way or better, or no, it's going to be more expensive. You need to have whoever you're going to work with to do your construction, or we call it CapEx. But how are you going to improve that property? Whoever's going to be doing that needs to get their eyes on the property and look over the business plan and approve the budget and make sure that, those things that we can do that within the allotted money, within the allotted budget to make the project work too. So there's several people that need to come into play. There's also the due diligence piece where you need to walk the property beforehand to make sure there's nothing that you can't see, right? In all these properties, there's stuff hidden behind the walls. You got to get up on the roof. I guess what I'm getting at is it's a long process. You typically get a 30-day due diligence period to get in and look at these things. And then you have 30 to 45 days to close. Now you get that 30-day due diligence period, but a lot of times it'll cost you something. You're gonna have to put up a deposit that oftentimes is non-refundable as soon as you sign that contract. But certainly there is a feel to it. For me, there's a lot of prayer that goes into it. There's a faith element to it. And then there's also a team that surrounds me and walks the property. We build this plan and we bounce it off our third-party partners who are going to be working this project with us. And at some point, you got to say, okay, we've done everything we can do. This is what we're set up to do. This is the business we're in. And we got to take that next step forward and put it out there. And then knowing that once we close that deal and that business plan goes into place, that we're going to do everything we can to make it successful, everything within our control, we're going to do to hit and exceed the expectations that we put forth during the underwriting process. But it's always difficult, and these projects are expensive and they require a lot of money. There's a lot of capital involved, a lot of people involved. So yeah, there's a lot of pressure to make sure that we're underwriting thoroughly, that we're doing a good job, that we've got, like I said, the right people that have the right skills are giving us the right information. So there's a lot that goes into it. But at some point you have enough to where you feel peace about, yeah, okay, this is a good opportunity. Let's move forward. And we think that not only can it be successful for our investors, but we think this is a good idea for the business, can help the business grow. But just like anything else, though, at some point you just got to take that next step. And there's always going to be the little hesitation because there's a lot on the line. There's a lot of money here. But I think you can put a process in place that gets you far enough along. You're just like, hey, I feel like we've done our due diligence, we've done our homework, and I've got peace, and let's go.
Managing someone else's money has got to be a heavy burden. It would be for me. From a CPA standpoint, we get to save people money, but as actually managing it and being responsible for a return, an expected return. Most investors invest expecting it, even though they understand risk, they understand that they could lose it, but the expectation is I am going to get a return. So that's a lot of weight that I would feel on that. And I love how you mentioned that you're going to have a team around you. You have quality people and that you
Mm.
have certain people doing certain things in their designated space. So how did you find your team? And can you talk a little bit about the importance of your team? Because we're strong believers of the same. Being CPAs, we know taxes, but we don't know real estate syndication management. We don't know financial advising, retirement planning, and things like this. So we have people like you and other professionals that we kind of lean on, and it's so important to work with someone who understands that. So how did you find your team? And talk a little bit about that if you don't mind.
Yeah, absolutely. So my family's involved. My brother's involved in the business. He handles all of our business management, administration, our analyst or primary underwriter. We did several development deals before we got into the existing multifamily. He was a banker that we used. He's a commercial underwriter that we used for years, and he came aboard. We got a project manager. He's an engineer. He's got a background in oil and gas. He worked at a church doing IT, and then he moved into the multifamily space. I met him at church, and we clicked, and he's just an incredibly competent guy. He handles our project management, CapEx. He also does some general asset management for us. And then acquisitions person, same way. Met him through church. But really, it's for me, I'm looking at character and competency.
Mm.
Do you have the right character? Do you fit the culture? Do you get along? Do you get the vision? Do you see where we're going? And does that excite you? Do you want to be a part of this? And then do you have the competency? Do you have the God-given skills to fill that role well? And do you have the capacity to grow and learn? Because obviously we want to continue to grow. And as you grow, things get more complicated. It gets harder, more stressful. There's more pressure. Like you said, the more money gets involved, the more investors that put their trust in you, the stakes go up, the pressure goes up. So we need to constantly be getting better and better. For me, I've been blessed that the team that I'm surrounded with is really come together naturally. I haven't gone out and hired people to do certain things because those relationships are already in place. And like so, I think it was a blessing that the right people came at the right time. And big important for us, we work with a lot of third-party contractors. The number one person, in my opinion, of who's going to make that project go, who's going to be most critical to the success of that project is going to be the on-site manager. They put the systems and the processes in place. They're set up to support that on-site staff, make sure they have what they need. They're getting the right reading. They can interpret the data. They know what to do with what they're looking at. But the person that engages every day with those tenants and is signing up the leases and is making sure that the property is running the way that it's supposed to be is that on-site manager. And so that has been a process for us. We've used for several managers. We've now kind of narrowed it down to one that we really like. In our journey to this point, the team that's close to me, we call it the asset management team, the investment management team, has been built out in a really special way. I've been able to just bring people in that I've met and formed a relationship with, and they just haven't had the skill set that fits a certain need. But the third party stuff, we've worked with property managers that we haven't had a great experience. We're in third party contractors and things that hasn't worked out the way that I'd like. But it just takes time, right? It just takes time. You have to set expectations. You have to hold people accountable to certain goals and metrics. Those have to be clear. People have to know what you want, know what you need, when you want it, when you need it, and why it's important. And I think what we found that now with the third-party contractors that we use, it's been a trial and error. It's been working with people that some that work out, some that don't. And you just kind of narrow down to, hey, who's the right fit for us? Nothing against the people that don't work out. It just isn't the right fit. That'll always be the case though, right? We're always going to be dealing with that. That's okay. That's fine. And when you find that right fit, it's really great.
So if I'm looking to get into, I'm new in real estate syndications and I'm looking to get into one, how strongly can I count on the pro formas that come out in those offering memorandums? I've seen a lot of people try to shoot for blue sky in their PPMs when they're trying to raise funds, and they're not always reasonable at all. So how would you recommend just a normal new investor look at your predicted financials, your first year financials that you come out with? Someone's looking at them. What would your recommendations be?
Yeah. That's a great question because a lot of people underwrite so many different ways. Probably when you're looking at pro forma, one thing you need to look at is when you're looking at the comps and the rents, there should be data in there. What are the comps? What are the properties? What are they asking for? And a lot of times those are asking rents. We're not going to see what the real rents are. Those are their asking rents because that's all the information that we get. If you go on apartments.com, you're going to look at the asking rents. We don't know what those leases are actually signed up for. But if someone's promising astronomical returns, a good rule of thumb is a 6 to 8% distribution, preferred return, and then a 15% on an existing property plus or minus overall return, annualized return. Those are kind of the market standard, and the reason they are is because they're achievable. They're something that people can typically hit without some type of crazy market rise like we saw in the last couple of years with the cheap money, or without some crazy improvement. You're going into a new development, you're going into a total overhaul of a property, we're going to increase value by investing a lot of money into it. That's different. And there's also more risk there, right? So your expectation of the return should go up too. Then you're looking at 20 plus. But as a new 20% annualized return, but if you're a new investor, I would really caution, if you're seeing something that looks as 20% rate of return, something like that, it doesn't mean it's not there. It doesn't mean it's not achievable, but certainly go in and read through the whole pro forma, the whole deck, and see what the business plan is, how we're going to get there, and just follow those revenues. The expenses are going to be pretty standard. Your biggest expenses in a part, they're going to be your payroll for your staff that's operating. They're going to be your taxes and your insurance. Those things are going to be pretty standard. And then there's some variable expenses in there that typically the historical numbers will be pretty close to. So you can kind of gauge that. But when you're looking at your revenues, you really want to see, where are you getting these numbers? Where are you getting these increases? And hopefully in most decks, a syndicator will also give you some macroeconomic data, a reason to believe that the market's going to move this way, and some more information specific to that, some microeconomic data for that specific market, even that sub-market. It's different there too. So I think the biggest one is just look at those revenues. Does it make sense to you based on the comps you're looking? And nowadays, just hop on the internet and type in the name of the apartment that they're using for their comp, and you can get in there. Pictures will always look better. That's just marketing is what it is. But just get online and see what it looks like, and just see if that makes sense. Yeah, I think if this is run well, it's managed well, then it makes sense to me that somebody would pay that amount for this apartment, the same that they pay over here, they pay here, based on just what I'm seeing. Square footage, amenities, what the pictures look like. So just on the revenues, just track those revenues. And then of course, you can see, if we're going to put in $1 million into an apartment complex, then you've got some type of vision for that project. Like, yeah, putting this money here, let me see the allocation, let me see the budget allocation. That makes sense. You guys are putting this in interiors. That'll bring that up to that comp. I feel comfortable that amount of money is going to bring it up to that comp. That comp's making this on the leases. I feel good. Okay. I see how you're getting there. That's my advice. A good syndicator, a good sponsor, you'll be happy to talk through why they think that'll get there. If you don't feel good about their explanation as to why it's going to get there, then yeah, that's a red flag. But that's another way to do it. Just watch the revenues. Make sure the revenues make sense.
Great advice.
Yeah, that's a lot of knowledge and wisdom in that past 2 minutes. I would encourage you to rewind and listen to that again. That is a wealth of knowledge that he just walked through. So that's awesome, Josh. Thanks for sharing that. As these potential new investors are wanting to dip their toe in these waters, what's the barrier to get into a type of investment like this? Can anybody get into it? Are there requirements on income? Kind of walk somebody through that piece as well.
Yeah. So we open ours up to accredited investors, and we can kind of talk through the definition of what that is. But there's net worth requirements, income requirements to determine whether or not you qualify as an accredited investor. And the reason we do that is for reporting requirements. If you allow unaccredited investors to come in, it just puts a little bit more of a reporting burden on the entity. But per the SEC rules, now, as long as you are raising underneath a certain threshold, then you certainly need to file with the SEC. You need to file an exemption, but you don't necessarily need to register as long as you are within or underneath a certain level of investors and a certain level of money that you're raising. And that's obviously a conversation for your attorney, not me. But for us, if you qualify as an accredited investor, then what happens is you fill out a subscription agreement and you sign on to the company agreement. So it's a 3-step process. There's an accredited verification, accredited investor verification. There's a subscription agreement that basically lays out, this is at the level I'd like to participate. I understand the risks. I understand what I'm getting into, just general information. And then there's a company agreement that governs the investment, right? That lets you know, how are the distributions going to go? How are the profit loss allocations going to go? When we have major decisions, who's going to make those? If we have to have a capital call, how does that work? That'll walk you through exactly, as things come up, how are they going to be handled? What does the manager have the authority to to do. Certain things will come up that the manager can't just make a unanimous decision. There's got to be a majority vote that says, hey, this falls outside of your realm of approved authority. We need to have a vote and to decide if we want to move this way or that way. So those are the three main things for us is, are you a accredited investor? Here's this subscription agreement lays out the risks of the investment, the general information, and the company agreement, which you have to agree to, that says this is how we all agree that this investment is going to be governed. And these are the rules basically that we're going to abide
some
by.
guardrails, some rules for the game. It helps. And make sure everyone's on the same page and agrees and no one's taken by surprise.
And I think, it's really important too that everyone knows the risk going in, right? It's really important to know that while we think this is a great investment, there's risks associated with everything. So just make sure that everyone's comfortable. Because one thing about these investments that I like to point out is they're very illiquid, right? If you put your money into this apartment complex, depending on like the term of the deal, we're going for 3 to 5 years, typically in our investments. Well, within those 3 to 5 years, your money's sitting over there in that building. It's not so easy to get it out. Now, hopefully when you do get it out, it'll be much greater than when you put it in, but just to keep that in mind too, it's not a liquid investment.
Yeah, that's great. I think I want to just kind of have you pull out your crystal ball one more time for Mike.
Put you on
He loves
record
it
here,
so
Josh.
much.
I'll do my best.
What would you feel kind of the kind of near future, and looking out 6 months or so? How do you view the market? And I know you're kind of the expert in the DFW area, so just speak to that. What do you anticipate coming up the pipeline, and how should people get ready for it?
Well, I don't think the Fed's done. Right? Everyone is anticipating, or most people are anticipating, a 25 basis point hike next week. So we're going to see that rate continue to go up, and then where they stop, what their terminal rate is, and how long they keep it there, I don't think they know, right? I think they're going to be very data dependent and try to stamp down inflation as best they can without overdoing it and causing a really bad, long recession. So I think, though, the sentiment's been kind of, if you listen to some of the commentary coming out from some of the Fed governors, they might be starting to cool a little bit. You don't hear as much of we're going to go up till 5.5 or to 6, no matter what it costs, just because inflation is that bad and it's that important to us to stamp it out. So I think we're starting to see, as we've gotten 2 or 3 months of positive CPI readings, I think January will continue to come down again. I don't think there's any reason to think that inflation is going to go back up anytime soon. So with inflation coming down, we're starting to see in some of the manufacturing reports and some of the layoffs that we're seeing, higher number of layoffs. We're starting to see, I think, the previous hikes really come into really start having impact. So my guess would be moving forward is the Fed will get up. They're at 4.5. They'll probably get up to 5% is what I think. And then they'll pause for a while. I think we'll continue to see layoffs. It'll be a little rough in between now and then. But then I think they'll pause. The market will take a breath. Everybody will kind of see, okay, we got a better idea of where things are going, how things are. We see like some light in the tunnel. We see some things starting to stabilize. And then hopefully if inflation continues to come down towards that 2% target that they want it to be, then they'll maybe start cutting at the end of the year this year. So as soon as they do that, as soon as they start cutting, typically if they start cutting, we're in a bad place, right? We're in a recession. So money's going to pour into the bond market. It was going to pour into those long treasuries. And in doing so, that's going to bring borrowing rates down for all of us who invest in long-term assets. So if that happens, then we'll see a run on, I think, multifamily and other commercial and retail yet to be seen. That'll be really dependent on where the economy is at that time. But in multifamily, I think we'll see a run on properties, and it'll be a good place to be for the next several years, especially in the right locations like Texas, like we talked about in DFW. So I think increase 2 more times, maybe a third time, 50, 75 basis points. I think there'll be a pause. I think they'll be satisfied. There'll be a reason to start cutting. I think we're seeing enough cutting rates. I think we're seeing enough in the inflation reports and some of the economic indicators. All the leading economic indicators are down. So we're seeing a lot of information that would suggest it's working. The Fed had a mission, they had a job to do, and they're doing it. And so hopefully they're almost done. They're starting to see that what they wanted to do is happening. What they've done is working. Hopefully they can take a victory lap here soon. And in doing so, they can start cutting rates. Financing becomes more affordable. All of a sudden, activity and commercial real estate starts to pick up.
So yes or
Hopefully by the end of this year, it'll be good.
awesome. Yes or no quick. Do you think we can actually achieve a soft landing?
I don't know, because the Fed, they're saying they want the unemployment rate to be 4.5. It's over 1 million jobs lost from where we are now. It depends how resolute the Fed is. If they're willing to allow us to get to that 2% inflation rate over a longer horizon, I think maybe they can slow play it a little bit more. If they continue to hike regardless of kind of what some of the economic data is showing, then I don't think there's any chance of a soft landing. When I say that, I don't think that we're looking at a really crazy recession either. I think maybe like a mild reset. And then as they start to get softer and softer in policy and money becomes cheaper, I think there'll be a really great recovery. So don't think they're going to avoid recession, but I also don't think it's going to be long and deep. I think it'll be kind of mild and short. It'll be a reset. Hopefully get all that excess liquidity out of the system, drives inflation down, and then we can start to recover. And once we do so, I think it'll be a really strong recovery, both in real estate and equities and everything. So I think we're in for a little bit of pain further, but a really strong back half of the year.
Well, that's
knowing that you've predicted correctly in the past, I'm going to take that to the bank and hold you to it, Josh.
Well, yeah, I don't know, Mike.
And the worst part is it's January 23.
I don't think anyone
so
really knows.
we can save this recording and listen to it all and laugh in 6 months. Josh, thanks so much for being on with us. You're just a wealth of knowledge when it comes to real estate syndications. You even taught me some things with how to vet a property and everything like that. So thank you so much for being on. And if someone wanted to get in touch with you, or they had some questions, or were interested in just discussing potentially investing with you, where do they go? How do they get in contact with you?
Thanks, Kevin. Yeah, and it's great to be on with you guys. I learned something every time I talk to y'all, so much appreciated. Hopefully some of the stuff I said can be helpful to somebody. ALX Real Estate, the best ways to get in contact with us is go to our website, alxrealestate.com. We're revamping the website, so it'll have a new look to it here soon. But that's the best way. There's a place on there where you can send a message and we'll reply. We're on LinkedIn too. So LinkedIn or the website are the two best places.
And we'll show
Be happy to talk to anybody that's
interested.
interested.
So those will be in the show notes as well, alxrealestate.com, as well as our LinkedIn profiles. Well, thank you, Josh. Appreciate it, man.
No, thank you guys. It was great.